Supernus Pharmaceuticals Q3 earnings and revenues beat out analyst estimates. Let's run their financials through a discounted cash flow model to see whether the stock is a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Supernus Pharmaceuticals stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. Supernus is a pharmaceutical company focused on developing and commercializing products for the treatment of central nervous system diseases in neurology and psychiatry. Let's get started with the model. This is a small cap company, 1.1 billion market cap. They're trading at $21.75 a share, and they have 53 million shares outstanding. Let's look at their financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things unless it uses cash off its balance sheet or goes into more debt. This company has positive and growing free cash flow each year, which looks really good. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have positive and pretty consistent net income each year. Revenue is the sales for the company. Their revenue almost doubles from 2016 to 2018, but then drops a little in 2019. Their margins look pretty good. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. So in 2019, they converted 29% of their revenue into profit, which means 71% went towards expenses. Their income statement looks pretty good. In 2019, they had $392 million of revenue, and the cost of revenue was only $16 million, so their gross profit was $376 million. Operating expenses are all the expenses that are not directly tied to making the company's products. Research and development fall into operating expenses, also depreciation, and also payroll for support functions like accounting or HR. They have about $150 million of operating income, and their interest expense is pretty low, only $1 million. They don't have much in the other column either, so they had $113 million of net income in 2019. You can see in 2016 they had negative $40 million in taxes, so that $40 million increased their net income because they had $50 million of income before taxes. Then if you add $40 million, they had $91 million of net income. This is called deferred taxes, so they don't actually get a rebate. They do have to pay the taxes in the future. This comes about due to the timing difference between the IRS and GAAP accounting. Let's look at the statement of cash flows. The way you calculate free cash flow, it's operating cash flow minus CapEx. And this type of company doesn't need to spend too much money in capital expenditures. CapEx is property, plant, and equipment. So their financials look pretty good, no big red flags. Let's look at the capital structure. $378 million of debt, $595 million of equity. They pay 6% interest on their debt, and cost of debt is 4.6%. To calculate cost of debt, it's interest rate times 1 minus the effective tax rate. And 39% of that capital structure is debt, which means 61% is equity. Cost of equity is 13%. And to calculate cost of equity, we use a capital asset pricing model. And part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market. So the market as a whole has a beta of 1. This stock has a beta of 1.39. So the stock is a little more volatile than the market. And their WACC is 9.73%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $2.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.2 billion. We divide that by 53 million shares. Calculated stock price of $41. They're trading at about $22, so they're trading at a 47% discount. It's a strong buy according to the model. Simply Wall Street is in the other direction. They're saying the stock is only worth $15.56, so they're saying it's overvalued. It's a sell. Let's see where the stock has been trading at the past few years. So the stock peaked in the low 50s, but it's been driven down the past couple of years. If you own this stock in 2015 or 2016, you haven't made much money on your investment. From December 2014 to December 2019, this stock has outperformed the NASDAQ Composite and the NASDAQ Pharmaceutical. This company has never paid a dividend and does not plan on paying dividends in the future. If you invested $10,000 in this company when it IPO'd in 2012, you'd have $33,800 today. That's a 240% return. I pulled this chart from their annual report. You can see their prescriptions by year. In 2013, it was only 33,000. Then it went up sixfold in 2014 to 198,000. And it seems like it's been growing every single year. It's good to remember that a company's financial performance is not 100% correlated to the changes in the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if there are more buyers than sellers. The stock price will go down if there are more sellers than buyers. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and its stock price keeps going up. The market is forward thinking. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest things to figure out. In the short run, no one can predict the stock market, but if you invest in solid companies with good fundamentals and hold long term, you should be better off than most investors. The reason I like focusing on financials is because all the information is there. If you listen to others, they could spin their narrative to make the company look great or look terrible. Let's look at the financial ratios. The average PE in the market is 16.9, the median is 15.2. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 10.1, so they're doing better in PE when compared to the market. The average price of sales is 4.7, the median is 2.0. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 2.9, so they're between the median and average. The average price to book is 4.8, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 1.9, so they're doing better than the market. Equity equals assets minus liabilities on the balance sheet. The average interest coverage ratio is 12.6, the median is 3.9. Interest coverage ratio is EBIT over interest expense. They're at 6.5, so they can easily cover their interest payments. The average ROE is 13%, the median is 12%. ROE is net income over equity. They're at 19%, so they're doing better than the market. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They're at 2.9, so they can easily cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. If a company has a current ratio above 2, that can be a sign they're not using their current assets efficiently. So you can see they're sitting on a lot of cash, $347 million, which is more than double their current liabilities. They could probably do more with the cash than letting it sit in our balance sheet. The best way to look at ratios to compare them to similar companies, I've done videos on Pacira and Teva, both in the same industry as Supernus. And if Supernus has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They're the only company of the three with a positive price earnings ratio. That means the other two companies have negative net income. A better price to sales than the average, also a much better price to book. Current ratio is higher than the average. They have the best ROE of all the companies because the other two companies have negative net income, so they have negative ROE. They have the lowest debt of the three companies, but they are the smallest in terms of market cap at $1.1 billion. So to summarize, I have them trading at a 47% discount. Their ratios and financials look really good. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.